Now coming to the next chapter, there is chapter number 5. In this chapter we are going to talk about cost of capital. So cost of capital means the firm's cost of raising funds. So cost of capital can be defined as the minimum rate of return a company must earn on its investments so that the market value of company's equity shares does not fall. It is related to the long-term capital funds. So we know that cost of capital is firm's cost of raising funds. Also, this is defined as minimum rate of return a company must earn so that market value of company's equity share does not fall. And this is related to the long-term capital funds. Now determining the cost of individual components of the capital. Well, there are basically 4 sources of long-term funds for a business firm. These 4 sources are, first one being the long-term debts and debentures, preference share capital, equity share capital and the retained earnings. 4 basic sources. Long-term debts and debentures, preference share capital, equity share capital, and the 4th one being the retained earnings. Cost of capital is basically the weighted average of the cost of capital sources. The funds may be raised by a concern from one or more of these sources. Now, in order to calculate the weighted average, we should first know how to calculate the individual financing sources. Taking up the first component, first basic source of long-term fund, that is long-term debts and debentures. Let's learn to calculate its value. Long-term debts and debentures. First of all, in case of an irredeemable debt, cost of debt at par can be calculated as we mention it as KD, that is cost of debt is equal to interest 1 minus tax. KD is cost of debt. This was cost of debt at par. Now is cost of debt at discount or premium. This can be calculated using the formula KD is equal to annual interest payment divided by net proceeds 1 minus tax. This was in case of irredeemable debt. Now coming to the cost of redeemable debt. This is page number 33 and cost of redeemable debt. This can be calculated using the formula interest 1 minus tax plus RV minus NP divided by life. The whole thing is to be divided by RV plus NP divided by 2 and into 100. We have done this formula earlier also. So where RV is the redemption value, NP the net proceeds, life is the life of the debt. Let's understand this with the help of an example. So this is the first example. Now a company issues 10% irredeemable debentures of rupees 10,000. The company is in 50% tax bracket and we have to calculate the cost of debt in 3 situations. Question is, company issues 10% irredeemable debentures of rupees 10,000 The company is in 50% tax bracket and calculate KD, that is cost of your debt. 3 situations, first being at par, second is at 10% discount, and third is at 10% premium. So we'll be using these formulas that we wrote on the last page. KD, interest 1 minus tax in case of cost of debt at par, and in case of premium or discount the formula will be annual interest payment 1 minus tax divided by the net proceeds. So first, in case of calculation of KD at par, interest, how much is the interest? 10% of rupees 10,000, that is 1,000 is the amount of interest. We are paying 1,000 rupees on 10,000. Net proceeds that we received are 10,000 and this is tax deductible, so we will be doing 1 minus tax, that is 0.05. No, 50%, no, 0.50. So this comes out to be 5%. Second is calculation of KD at 10% discount. Or simply we could use this formula 10, 1 minus 0.50, that will also give you 5% KD. If you are not using the absolute amounts, you can also use this formula. Second is calculation of KD at 10% discount. This was 10,000 into 10%. So what this 10% discount means is the company will pay 1000 rupees as an interest component. However, it will receive 9000 rupees and not 10,000 rupees from the public. That is, the net proceeds the company will receive is 9000 because these are issued at 10% discount. So interest in this case will be 1000 only. However, the net proceeds will change to 9000 and this is tax deductible. So 1 minus 0.50, that is your tax rate. And the cost of debt in this case comes out to be 5.55%. The third is calculation of cost of debt at 10% premium. Calculation of KD at 10% premium. So the net proceeds in this case will change to 11,000. However, the interest payment will remain the same at 1000. So the cost of debt in this case is 4.55%. So taking up another example, this was for irredeemable debt. Now we'll take up an example to cover the situation of redeemable debt. Second example that we are doing. Now a company issued 100 10% debentures, each of rupees 100 at 5% discount. Now this 10% is the rate of interest given. Each of rupees 100 at 5% discount. The debentures are to be redeemed at the end of 10th year. At the end of 10th year, tax rate is 50%. And calculate cost of debt. First of all, let's write down the formula. There is interest 1 minus tax plus RV minus NP divided by life, and the whole thing is to be divided by RV plus NP divided by 2 into 100. Now the interest rate is 10%. So this is 10. Tax rate is 50%. Redeemable value is redeemed at the end of 10th year. So if nothing is mentioned in the question, we will assume that the debentures are to be redeemed at par. So par value is 100 minus net proceeds. Since the debentures were issued at 5% discount, the net proceeds the company would have received is 95. That is 100 minus the discount of 5 is 95. Life of the debentures is 10 years. The whole thing is to be divided by 100 plus 95 divided by 2 into 100. So how much does it come out to be? This is 100 minus 95 divided by 10 plus 5 is 5.5 divided by 100 plus 95 divided by 2 is 97.5 into 100. This is 5.5 divided by 97.5 into 100. 5.64%. So this is how we can calculate the cost of debt in case of redeemable and irredeemable debt. Now calculation of cost of capital using the interpolation. Next topic is calculation of cost of capital using interpolation. So we'll use the IRR technique in this for calculating the cost of capital. Let's see this with the help of an illustration. A company has issued 11% debentures for rupees 20,000. 4 rupees, not 20,000, it's 2 lakh. 4 rupees, 2 lakh. The underwriting, brokerage, and other issuance cost amounts to rupees 10,000. The term of debenture issue provides for repayment of principal in 5 equal installments. Repayment of principal in 5 equal installments. Starting at the end of first year. Tax rate is 60%. Calculate cost of debt capital. Okay, so I've kept the question aside and let's do the solution here. So first of all, let's see how much the company will receive as an inflow. So this is the question. A company has issued 11% debentures for rupees 2 lakh. The underwriting, brokerage and other issuance costs amount to rupees 10,000. So the net amount the company will receive is 1,90,000, that is the debenture amount minus the cost of underwriting, brokerage and issuance cost. So the company will have a cash inflow of 2 lakh minus the brokerage and issuance cost 10,000, that is rupees 1,90,000. Now we will calculate the interest and principal component. This is calculation of interest and principal component. So now debenture are issued for rupees 2 lakh. Issued for 2 lakh. And repayment in 5 years. Repayment is in 5 years. So the principal amount paid every year is 2 lakh divided by 5 is 40,000 rupees is principal paid every year. So let's calculate the interest and the principal part. Here 1, 2, 3, 4, 5 issued for 5 years. How much is the principal paid every year? Principal paid is 40,000 every year. $40,000 and $40,000. How much is interest paid? In the first year, the interest is paid on the entire amount of 2 lakh. Interest is 11%. 11% of 2 lakh is 22,000. In the second year, the 40,000 principal will be paid by the company. So the net balance remains is 1,60,000, that is 2 lakh minus 40,000. So the interest will be paid by the company on 1,60,000 only for year 2. 1,60,000 into 11%, this is 17,600. Now is 1,20,000, 80,000 will be paid by the company by the end of year 2 into 11% is 12,200. 80,000 into 11%, 8,800, and 40,000 into 11% is 4,400. Let's add up the principal and the interest paid. 40,000 plus 22,000 is 60,000, 62,000, and this is 57,600, 52,200. This is 48,800 and 44,400. Now let's assume two discount rates as 12% and 14%. Assume discount rate at 12% and 14%. Now we'll calculate the present value at 12% and 14%. Calculate PV at 12% and 14%. So now we have here 1, 2, 3, 4, 5 and total of principal plus the interest paid 62,000, 57,006 here. These I am picking up this total amount 52,200, 48,800 and 44,400. Present value factor at 12% first. This can be calculated as 1 divided by 1.12 equal to first 0.893, 0.893. The second year it's 0.797, 0.797. For third it is 0.712, 0.712. For fourth it's 0.635. Is it 635? 0.635. For fourth it's 0.567. Recheck it once again. 1 divided by 1.12, 893, 797, 712, 635 and 567. Okay, let's calculate the present value for this. 62,000 into 0.893 is 55,366. 57,600 into 0.797 is 45,907. 52,200 into 0.712 is 37166. 48,800 into 0.635, 30988, 0.567 into 440 is 25175. Let's add up these all. Double 5366 plus 4590 7 plus 37166 30988 and 25175 194602. Present value factor at 14%. 1 divided by 1.14, 0.877, 0.769, 0.675, 0.592 and 0.519, and calculate the present value. 0.877 into 62,000, 54374, 0.769 into 57,600, 44294, 0.675 into 52,200, 35235, 48,800 into 0.592, let me make it 90, round it off to the next digit, and 00 into 0.519, 23044. Five 4,374, 44294 plus 35235 plus 28890 plus 3044. This is 185,837. Now using interpolation, this is lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into difference in rates. So lower rate we have taken as 12. NPV at lower rate is 2 lakh minus 1,94,602. 194,602 minus 2 lakh. 5398. Divided by NPV at lower rate, this is the same, and NPV at higher rate, 2 lakh minus 185,837 is negative of 14,163. No, this is NPV at higher rate, how much it is? 2 lakh minus 185,837, 14,163 into difference in rates is 2. 5398 plus 14,163, 5398 divided by memory recall into 2 plus 12. So this comes out to be 12.55%. coming to cost of preference capital. That is KP. Till now we have done KD, cost of debt capital. Coming to the cost of preference capital now. Cost of preference capital. There is KP. Now here what we are trying to calculate is, when a company issues preference share capital, what is the cost of issuing such preference shares? Well, it's simple. The company pays dividend on preference shares. So whatever the company is paying as dividend is the cost to the company. Further, dividend paid is not tax deductible, as the company is not allowed to claim dividend paid as an expense. Further, preference shares can be redeemable preference shares and irredeemable preference shares. Redeemable preference shares and irredeemable preference shares. Now, redeemable, these have to be redeemed as the name suggests. So in this case, company will have to pay dividend as well as the principal on redemption. So cost of debt in this case will be dividend plus redemption value minus net proceeds divided by life. The whole thing is to be divided by RV plus NP divided by 2 and multiplied by 100. Now these preference shares, irredeemable, these preference shares are not to be redeemed. These are not to be redeemed. So only dividend is paid on such preference shares. Only dividend is paid on such preference shares. Cost of preference capital is, this is KP. Cost of preference capital is dividend per share, and this is to be divided by the net proceeds. Now net proceeds are market price minus the issue cost. Market price minus issue cost. Preference shareholders are paid in preference over the equity shareholders. Preference shareholders are paid in preference over equity shareholders. Let's look at an example. The example is, a company issues rupees 100 face value preference shares with a dividend of 12%. Company issues rupees 100 face value preference shares with a dividend of 12%, repayable after 10 years. The net amount realized per share is rupees 92. Calculate cost of preference capital. We know the formula, we just written down. KP is equal to dividend plus RV minus NP divided by life. The whole thing is to be divided by RB plus NP divided by 2 into 100. So we'll directly do the question here without writing down the formula. Dividend, how much is dividend in this case? 12% on face value of rupees 100, that is 12. Plus RV, redemption value is, if nothing is mentioned in the question, we'll assume that the preference shares will be redeemed at par. So the redemption value becomes 100 and the net proceeds from the issue are 92. This is to be divided by the life is 10 years. The whole thing divided by RV plus NP divided by 2 into 100. So let's solve this. This is 8 divided by 10.8, 12.8 divided by 192 divided by 2 is 96 into 100. 12.8 divided by 96 into 100 is 13.33%. So this was how to calculate the cost of preference capital. Coming to cost of equity capital. This was about it, 13.33%. Cost of equity capital. Cost of equity capital is represented by KE. Cost of equity capital. That is KE. Now KE is the discount rate which is equal to the present value of all expected future dividends per shares as perceived by the investors. There are various approaches for computation of cost of equity capital. KE is the discount rate which is equal to present value of all expected future dividends per share as perceived by investors. Various approaches for computation of cost of equity capital are: first is earning price ratio method. Earning price ratio method. This is KE is equal to earning, this is earning price, earning divided by price, that is current earning per share divided by current market price per share into 100. Now this method does not consider growth in earnings. It does not consider growth in earnings. The second approach we have is earning price ratio plus growth rate method, that is EP ratio plus growth rate method. EP ratio plus growth rate method. Now this method considers growth in earnings. This method considers Growth in earnings. A period of 3 years is usually taken into account for growth. The formula for this is KE is equal to current EPS. EPS is earning per share. 1 plus G, G is the growth, to the power 3 divided by current market price per share. Or we can write it as EO 1 plus G Q divided by P0. Let's take up an example. EPS is rupees 5. EPS is rupees 5. Growth over 3 years is 10%. Market price is 50. And you are required to find the cost of equity capital. So, we'll just put the above formula. KE is equal to current EPS, which is 5. 1 plus G, growth rate is 10. And the cube of this divided by market price, which is 50 into 100. Into 100 because we want to calculate it as a percentage. 1.10 cube into 5 divided by 50 into 100. This is 13.31%. Coming to the third method, we have is dividend payout ratio method. C is dividend payout ratio method. In this we calculate KE as KE is equal to dividend per share divided by market price per share. Dividend per share divided by market price per share. Next is DP plus growth rate method. DP plus growth rate method. This can be calculated as KE is equal to D1 upon P0 plus G, whereas D1 is expected dividend at the end of year 1, expected dividend at Y1, and P0 is market price per share. This formula is generally used to calculate the current price per share, so which is P0 is equal to D1 upon KE minus G. Let's take up an example. Market price per share is equal to rupees 50. Is equal to rupees 50. Dividend at Y1 rupees 4 per share, and dividend for last 6 years for past 6 years are also given to you. For 1998, 99, 2001, 2 and 3. 1998 dividend of 2.97 was given, 3.12, 3.33, 3.47, 3.62 and 3.80. Now growth rate mentioned is 5% and you have to find KE. Let's do the solution to this. Now we know that KE is equal to D1 upon P0 plus G. D1 dividend at year 1 is rupees 4 per share. P0 is market price per share, which is given in the question as 50, and G growth rate is 5.05. So this is 4 divided by 50 plus 0.05 into 100 is 13%. So the past dividends given in the question are irrelevant for us in case we are calculating with the dividend payout plus growth rate method. Next is the capital asset pricing model. This is KE, calculation of KE using capital asset pricing model. Capital asset pricing model, popularly known as CAPM. So under this, KE is equal to RF plus beta, RM minus RF. Okay, so KE is cost of equity, you know it. RF is risk-free return. B is beta, security. RM minus RF is risk premium. This is the most widely used model, as this method incorporates the risk analysis. Let's take up an example for doing this. Rate of return on government security is 5%. On government security is equal to 5%. Beta is 1.25. RM is 12%. You have to calculate KE. So you can see clearly that CAPM method will be used here, as risk-free return is given, RM is given, and beta is given to you. So KE as per CAPM is equal to RF plus beta, RM minus RF. Here risk-free return is 5%. The government securities are always considered as risk-free. So 5 plus beta is 1.25. Return in the market is 12% and risk-free return is 5%. So 5 plus 1.25 into 7. This comes out to be 13.75%. Next is cost of retained earnings. Cost of retained earnings. This is represented as KR. Now when a company earns profit, it pays certain part of it as dividend and retains the rest to invest in the business to earn profit. It is an opportunity cost, as if the earnings are not retained in business and paid to shareholders. They could invest this money somewhere else and earn dividend or interest on this amount. So KR can be calculated as KR is equal to KE, 1 minus tax, 1 minus percentage brokerage cost. This is how you can calculate the cost of retained earnings. So let's take up an example for doing this. KE is 12%. KE is equal to 12%. Tax rate as 30%. Brokerage 3%. Find KR. So we have the formula here. KR is equal to KE 1 minus tax into 1 minus percentage brokerage cost. So let's do this. KE is 12%, 1 minus tax rate is 30% into 1 minus 3%. Okay, so how much does it come out to be? This will be 3%, 0.03 it is. This is 0.03. So 8.4 into 0.97. This is 8.4 into 0.97 is 8.148. That is approximately 8.15%. Now coming to the very last topic of this chapter is weighted average cost of capital. Weighted average cost of capital. In this, all you have to do is calculate the cost of capital as usual and multiply with their respective weights. This will give you weighted average cost of capital. This is also known as composite or overall cost of capital. The weights can be on the basis of book value, market value or target value. Calculate COC as normal and then multiply with their respective weights. Multiply with their respective weights. This will give you weighted average cost of capital. This is also known as composite or overall cost of capital. Composite or overall cost of capital. The weights can be on the basis of book value. Weights can be on basis of book value, market value or target value. Book value or market value or target value. So let's take up an example for understanding the weighted average cost of capital. Example is sources of funds. Debt, preference share capital, equity share capital and retained earnings. Amount is 3 lakh, 1 lakh, 4,50,000 and 1,50,000. Proportion of investment in the following sources are 30%, 10%, 45% and 15%. Cost is 8, 11, 18 and 18%. You have to calculate the weighted average cost of capital. Now calculation of weighted average cost of capital. It's simple. So in case this cost was not given to us, we had to calculate this cost first. This is cost of debt KD, KP, KE and KR. This is given to us and we'll just multiply it with their respective proportion and we'll get the weighted average cost of capital. So let's do it. Cost. This is source. Preference share capital, equity share capital. And there was debt also. Debt, preference share capital, equity share capital and retained earnings. And this was 8%, 11%, 18% and 18% and their proportion 0.30, 0.10, 0.45 and 0.15. So cost into proportion is weighted average cost of capital. This is 2.4, 1.1, 8.1 and 2.7. So this is 14.3%. So this was about chapter 5. I hope you enjoyed learning it. So we'll continue in chapter 6 with capital budgeting. Thank you.